Good evening, everyone. Welcome to India Karega Invest, an initiative of Groww to reach out to all of you every week with an interesting topic. We have been running this initiative for about 2 years now, and we come every Friday with a cutting edge topic, and we bring you experts from the industry to shed lights on it. And this week, we have another very, very interesting speaker. He is a portfolio manager and equity strategist at Aditya Birla Sun Life AMC Limited, or better known as ABSL AMC. He comes with an overall experience of 2 decades with close to 15 years in the financial markets and investment banking space. He has been associated with ABSL AMC since July of 2018. Prior to joining ABSL AMC, he was the Vice President of Corporate Strategy and Business Development with Aditya Birla Management Corporation Private Limited. Previously, he was an investment banker at Credit Suisse and also at Ocean Park Advisors in the US. Vinod sir is a CFA and has done his MBA in finance from the Wharton School, University of Pennsylvania. He holds an MS in industrial engineering from Pennsylvania State University and BTech in mechanical engineering from IIT Bombay. And these are very, very stellar credentials, sir. And we are super excited to have you. He is none other than Mr. Vinod Bhat. And today's topic is very, very relevant. I think we have all been doing our fair share of research, going through the internet to understand how the war is going to pan out and how it's going to impact our markets or the other markets abroad. Everything, I think we've been, our heads have been knocked. And I think a weekend is coming. So this is going to be a good, session where we can understand how the geopolitical tension is going to impact the markets. So today's topic is geopolitical tension and its impact on the markets. And we have Vinod sir here to shed light on it. So over to you, sir. And we are really, really looking forward to this session.
Sure. Yeah, thank you, Richa. Good afternoon, everybody. It's my pleasure to be here with you for today's session. Just give me a second. I'll share my screen. I have some slides to share. Just a second.
Yes. Also, feel free to post any questions you have for Sir, and he will definitely take them after the session. So use the comment section for that, and we will try and accommodate as many questions as we can from everyone. So,
Just one second. I am not seeing my presentation. Hold on. Yeah. Sorry about the
no worries, sir.
difficulties. Yeah. So you can see
We
my
have,
screen, right?
yes, it is. It is visible.
Okay, so the topic for today is the market outlook amidst geopolitical tensions. So I'll start by sharing some data points. So if we see what has happened, last year in calendar year 21, global equity markets had rallied to all-time highs, right? We saw, for example, in India, the Nifty gave almost a 25% return. Mid and small cap index gave almost 50 to 60% return. And even in the US, the Nasdaq and S&P gave 25 to 30% return. But in the past couple of months, as you can see, we have seen a correction globally. So in the US, S&P 500 is down about 10% from its peak, and Nasdaq is down about 15%, right? And in India also, Nifty is down about 10% from its peak. And In the US, especially in the Nasdaq, the tech sector has accounted for nearly drop half of the drop uh, that we have seen. Okay, uh, and especially for the beloved FANG stocks, there has been a significant correction. So earlier they were accounting for almost 25% of the S&P 500 by their weight. Now they have reduced to about 22%. And if you see the chart on the right, which is showing the price to earnings multiple relative to the S&P 500, we can see that there has been some normalization, but it's still not very cheap. So what we can say, it's becoming cheaper, but not outright cheap yet, right? So it's still about one standard deviation above the long term average. The other data point which is of interest also, if we see some of the segments and stocks that were like favorites in the market, like the fintech stocks, for example, or the futuristic companies, tech companies which are not profitable, there also we have seen the multiples correcting quite a bit, right? So if you see the price to sales for the fintech companies, again we are seeing like there has been a drastic reduction. They have come below the long term average, but there is still a chance that they may go even below, right? Same thing for the non profitable tech companies. Again, there has been a significant correction. They are closer to the long term average in terms of their valuation, but it can go still below, right? So essentially the growth sectors are becoming cheaper, but still they are not outright cheap. And even in India, if you see the multiples, like for example, if you look at the 1 year forward P multiple for the Nifty, after the recent correction, it has come closer to the long term average, right? And even, for example, another ratio that we look at, the yield gap ratio, which compares the earnings yield to the bond yield, that is also closer to the long term average, right? So slowly, essentially, because of the recent developments, valuations are normalizing after the recent correction. And now the key question everyone has is, what can we expect going forward, right? Can we expect the correction to continue, or can we expect the markets to rally from here on, right? And that is the question we will try to answer. Now, see, given that there are so many developments that happen, right, it is always good to have a framework in mind, so that uh, as and when you see something happening, you can focus on what are the key parameters that will impact markets. Because like Richa said, like everyone goes and reads up on the internet. You go through a lot of posts and tweets on social media, and everybody has their own opinions, and everything seems correct at some point in time, right? And it just leads to a lot of confusion. So it's very essential to have a simple framework in your mind, where you can fit in like the developments that happen in terms of the impact on the markets. So in that context, one thing you need to understand is how we define value. Right now, theoretically, value is defined as the discounted cash flow. Essentially, you look at the future cash flows from any business, you use some discount rate or interest rate to bring it to present value, and that gives you the value of the business. But that's theoretical, and in practice we apply a shortcut a lot of times. And in terms of a shortcut, for example, we use some multiples like a price to earning multiple or a price to book multiple and so on, right? So the simplest one everybody uses is a price to earning multiple. And essentially, the how do we define it? The numerator, which is the price, depends on the liquidity in the markets, the interest rates, and the sentiment of the flows. And the denominator, which is the earnings, it's largely related to the growth in the corporate earnings, right? So essentially, these are the four key parameters one needs to think of when we consider market movements in the short term. So essentially, the way to think about it is, in the short term the market moves due to valuation, changes in valuation. But in the long term, it moves due to changes in the earnings growth, right? Hence, given all the developments that are happening, let's try and look at the key parameters which impact valuation in the short term, right? Now, the most important one is the geopolitical tension which is happening right now. Okay. Now, what has happened in Ukraine, as you know, initially the expectation was that Russia would kind of attack and take control of two rebel provinces on the eastern side of Ukraine, and everything would stop there, right? So that's why NATO and the West also kind of initially didn't act too much. They were in a wait and watch mode. Everybody expected kind of Ukraine to surrender those two territories and things to go back to normal, right? But unexpectedly, what has happened is the Ukrainians are putting up a fight, which was not kind of in the plans, right? and hence now Russia has become more aggressive. So they have said that they are agreeable to having peace talks, but at the same time they are also doing military attacks on the Ukrainian military infrastructure, right? So number of cities have been bombed, and Russians are trying to take over the capital city, which is Kiev. The Ukrainians are resisting that. Now, because the tension has escalated, the US, Europe, and other countries have imposed a number of sanctions on Russia. The most important is that a number of Russian banks have been excluded from the SWIFT settlement system. The assets of the Russian central bank in the US and Europe have been frozen, so Russia can't use its foreign exchange reserves, right? And given that the West has imposed sanctions, Russia is also retaliating. Now it's uncertain as to how things will pan out in terms of the conflict and the war as such. How much time it will take. But the way it is impacting markets is through commodities, right? And how is that happening? Now, if you see this chart, the biggest exports from Russia are one, the precious metals like palladium, platinum, and gold. Second biggest is oil and gas, and then we have wheat, aluminum, nickel, and so on, right? So given the rise in the geopolitical tensions, that has impacted sentiment, that is impacting trade, and causing a supply demand imbalance. And that is why we are seeing a spike in all the commodity prices. So most important is the rise in the crude oil price, right? So if you see this chart, crude oil price is now at about $113 per barrel. It had yesterday gone up to almost $118 a barrel. There are projections that it can go up to $125 a barrel in the short term. And this is a key macro parameter that can impact the entire globe. What happens is that when crude prices rise, it pushes up the prices of other commodities, whether it's gas, coal, edible oil, fertilizers, and so on. That leads to higher inflation, that leads to rate hikes, that leads to slower growth. So essentially, the rise in crude prices kind of always heralds what we call as stagflation, which is slower growth and higher inflation. So that is a key parameter to watch. And especially for India, we are a big importer of oil. So any increase in crude oil impacts our country's finances. So 10% rise in crude oil increases our current account deficit by 0.3%, increases our CPI inflation by 0.4%, the wholesale price inflation by 0.8%, and impacts our GDP growth negatively by 0.1%, right? So clearly, the crude oil, increase in the crude oil is the most significant parameter for markets. And that's why we are seeing some correction in Indian markets over the past few days, right? And historically, if you look at which sectors get impacted, it's mainly the cyclicals and discretionary stocks. So, for example, you cement, paints, aviation, and then financials and so on. Those get negatively impacted, whereas defensive sectors like IT, FMCG, and healthcare tend to outperform. So that's at a sectoral level. And normally there is a kind of misconception that whenever oil prices go up, equity markets give negative returns. But our study shows that that is not really true. So since 1990, there have been 21 major instances when crude oil rallied more than 20% over 3 months, and in only 8 out of those instances, the Nifty has delivered negative returns. So in a majority of the instances, of 60% of these instances, the Nifty has given positive returns. And the average 3-month returns across all these instances is about plus 3%, right? So in the short term, there may be some impact, but even over a 3 to 6 month period, markets tend to come out of the impact of this oil crisis. The second driver for valuation is the increase in rates, right? So before the Russia-Ukraine conflict came into the picture, the US Fed was expected to raise rates by almost 7 times this calendar year, because inflation in the US is at a 40-year high. But given the uncertainty due to this conflict, now the Fed is expected to raise rates only 5 times, starting in March with a 25 basis point rate hike. Now, because of that, we are seeing that the US 10-year interest rate is already, reaching 2%. It had crossed that a few days back. And what happens is, when interest rates rise in the US, yields rise, and the Fed is expected to raise rates, the other central banks, whether it's the ECB, Bank of Japan, Bank of England, and so on, they also start raising rates. Even in India, the RBI is expected to start raising rates. We are expecting 2 rate hikes in India, right? And typically, when the interest rates rise, that's a negative for market valuations. The third is liquidity. So we know that over the past 2 years, the US Fed and other central banks had put in a lot of money into the financial system. For example, the Fed's balance sheet had almost doubled from about $4.5 trillion to $8.5 trillion, and they have started quantitative tapering. So they have started kind of reducing the supply into the markets, and they will finish that tapering by March, and then they are started expected to start reducing their balance sheet from May or June onwards, right? So whenever the Fed reduces the liquidity, sucks out the cash from the financial system, again that can impact market valuations negatively in the short term. The last is sentiment and flows, right? So clearly we are seeing that the geopolitical tensions have impacted sentiment. Investors have become more cautious. So if you see FII flows to emerging markets, we are seeing a strong outflow. So India, for example, in the past 2 months, Jan Feb, has seen an outflow of almost $8 billion. Other emerging markets in Asia also seeing outflows, and also given that the Fed is expected to start tightening, we can expect these outflows to continue for the next 1 or 2 months, right? But the saving grace has been the domestic flows. So we have seen, for example, SIP flows in mutual funds are at an all-time high of 11,500 crores a month. Every month, mutual funds are getting almost 20 to 30,000 crores in fresh inflows, and our domestic investors, retail investors, are also investing directly in the equity markets. So that has been providing support to the domestic markets. But overall, we need to keep track of what's happening on the FII sentiment also, right? So, so essentially, if we see in the short term, we have covered all the four key metrics that impact valuations. Like I mentioned, earnings growth, because of the rise in commodities, margins will get impacted, and hence earnings growth can get downgraded in the short term. Sentiment is getting impacted. That will affect FII inflows. Interest rates will start rising as the Fed starts raising rates and other central banks follow them, and liquidity will reduce as the Fed starts the balance sheet runoff. So clearly in the short term, we can expect that the valuation multiples can derate or can normalize from where they are at current levels. But like I said, in the medium to long term, so if you take a 3-year view, for example, markets are always driven by earnings, right? And hence it's important to get a view on what we can expect in terms of earnings growth. So there, if we see the corporate profitability in India over the past decade has been on a downtrend, right? So for example, 10 years back, it was almost like 7.5%. It has slowly declined to almost just 2%, given that our economy was also on a downtrend. But as we are coming out of this COVID pandemic, we are seeing that there has been a turnaround in corporate profitability. We are back to about 2.5% in terms of the corporate profit to GDP. And over the next 3 years, we expect the Indian economy to be in an expansion phase. So we expect that all the three drivers of the economy, whether it's consumption, investment, and exports, all of them will fire. And because of that, various sectors which were not doing well earlier, their profits will improve. So for example, the telecom sector, the PSU banks, they were all unprofitable over the past 5 years, and we expect their profitability to improve. Cyclical sectors, whether it's oil and gas, metals, capital goods, already we are seeing that they are at all-time highs in terms of profitability, and hence they will contribute to the overall profitability of the system. And lastly, the secular sectors like technology, private banks, healthcare, and so on, anyways, they should see an increase in profit. So overall, we expect that the corporate profit to GDP ratio to go back to its long-term average of almost 4.5 to 5%. So that means that in terms of earnings growth also, we are pretty positive. So over the next 3 years, we expect the earnings growth of the Nifty index to be about 15%. So that's higher than the last 10-year average of 11%, right? So as I mentioned, in the short term, we may see some downgrades to earnings given the rise in commodity prices. But if we take a 3-year view, then earnings growth is expected to be a strong 15% per year, higher than the long-term average. And that will provide a good support to equity markets. One interesting data point I'd like to share is normally before this correction happened, I used to get a lot of questions from investors saying that markets are at all-time highs. Should we continue investing or should we wait on the sidelines for a correction? Should we book some profits and so on, right? So if you see some of the data points like here, what we have done is looked at the returns from previous market peaks. So from Feb 2000 or December 2003, December 2007 or Feb 2015, when, for example, the Nifty index was at its peak, and then looked at the 3-year, 5-year, and 7 and 10-year CAGR returns that were obtained from that point. So if you see, if you look at 3-year CAGR returns, right, it's very unpredictable. So it can range from negative 13% to 0 to 5% to 28%. So it's very difficult to say what the returns can be in the short term, like 3 years. In the medium term, like 5 years, we can see that the returns are typically between 5 to 10%, right? And in the long term, like if you take a 10-year CAGR, then we can see that on average, you can expect 11.5 to 12.5% CAGR returns. So even when the market is at its peak, and if you invest, you can expect like 11.5 to 12.5% CAGR. Given that we have already seen a 10% correction in the markets, so you can expect a slightly higher return than this, right? So let's say a 13 to 15% CAGR. And if the geopolitical tensions continue, for example, we can expect another 5 to 10% correction. We are not expecting a significant correction, like more than a 5 to 10% correction. So expected returns can be higher, right? And also from a different way to look at it is, if we expect earnings growth to be about 15% CAGR over the next 3 years, and multiples to contract a bit, then again, the expected returns from equity markets can be slightly lower than 15%. So 13 to 15% CAGR over the next 3 years. So that is one framework you can keep in mind, right? But it's not to say that you should invest in a lump sum at this stage. Uncertainty is still there, so it's better that investors should do SIPs, and if there is a correction, then they can also add some amounts in lump sum. That would be a recommendation. Now, in terms of the themes that we are interested in, there are 5 themes I'd like to highlight. One is the private and corporate banks. As the economy recovers over the next 3 to 5 years, credit growth should improve, and the private banks and corporate banks are taking market share from the PSU banks, so they are expected to do well. Second theme is the shift from unorganized to organized, so larger players, listed players doing well, gaining market share, and we expect that to continue over the next 3 to 5 years. This is mainly related to a third theme, which is a low ticket consumer discretionary. So, for example, consumer durables, retail, auto, these sectors are expected to do well. We're already seeing, people are moving out of their homes, they're spending more after coming out of the COVID pandemic, and we expect discretionary consumption to improve. The fourth theme is the industrials and infra. The government has budgeted significant amounts for infrastructure development. They have announced a number of schemes like PLI, which should benefit the industrial and capital goods sector. So we are positive on those sectors. And it has had on our lives over the past couple of years. Even companies are spending more on upgrading the tech infrastructure. And hence, we should expect the IT services firms, the digital firms to do well over the next 5 to 10 years. Another theme which I have not listed here, but which is of interest, is the entire sustainability, green energy, and electric vehicles theme. And that will also be a decadal theme going forward. So that is something also you should keep note of. So just in terms of how to think of allocation in this regard, in terms of equity, you can have about 25 to 30% allocation to large caps. That will provide stability to your portfolio. About 35 to 40% allocation should be to diversified funds, so flexi cap, large and mid cap, multi cap funds. 15 to 20% should be to mid and small cap funds. They can do well as the Indian economy does well. And lastly, 15 to 20% can be to sectoral thematic funds, so banking and financial services, digital India theme, and consumption theme. And if investors are looking for lower volatility, they can look at, for example, a balanced advantage fund or a asset allocator fund of fund, as they give slightly higher returns than fixed income, but with lower volatility. So this is in terms of equity. But if you look at, for example, even the last 5 years, if you look at performance of different asset classes, we see that different asset classes have done well in different periods of time. So, for example, in calendar year 17, domestic equity has done well. Calendar year 18, fixed income and gold did well. Calendar year 19, international equity did well. Calendar year 20, again gold did well amidst the COVID pandemic. And calendar year 21, last year we have seen domestic and international equity have done well. So the point here is that it's very difficult to predict which asset class can do well. As many investors now want to invest, for example, in cryptocurrency also. So you can add that to this list. Again, it's a very volatile asset class. You don't know when it will perform well, when it will correct. So it's always good to think in terms of asset allocation and portfolio diversification. At least you should have these 4 or 5 asset classes in your portfolio. These asset classes are negatively correlated. So if one doesn't do well, some other asset class does well. that reduces the overall portfolio volatility and kind of gives you a stable return, right? And that is what you should aim for. So always, uh, it's always better in markets to bat like Rahul Dravid to protect your wicket. The longer you stay on the wicket, the more runs you score. Of course, in between, you can try and play like Rishabh Pant also, but the whole point is not to get out, to stay on the wicket and score runs. And for that, asset allocation is the mantra you should keep in mind. So what that means is, for example, at least in these four asset classes that I've showed, whenever we are in a bull market, you can think of reducing equity allocation, increasing the fixed income allocation, and having some allocation to gold, and maybe even if you want cryptocurrencies, but like not too much, like maybe 5 to 10% allocation and so on. And if there is a correction, like I mentioned, you can increase the equity exposure and take it up to like 60-65% and so on. So given that we are seeing a correction because of geopolitical tensions, so you should be ready, you should have some cash ready, so that whenever there is a correction, you can deploy some more amount in a lump sum and increase your equity exposure. So that is the way to think about, like the impact of geopolitical tensions on market valuations, but in the short term, but to keep an eye on earnings growth in the medium to long term, and then following the principle of asset allocation and periodic rebalancing of your portfolio, so that you can stay ahead of the curve. And last point I'd like to mention is, recently, like I have recently published a book where I've tried to outline all these principles in a simple way. The book is titled The Financial Independence Marathon. You can take a look at it, so that you can get a little bit more detailed understanding of asset allocation, various principles of financial planning, and how to think of investing in markets. So I'll stop here, and we can open the floor to questions.
Thank you so much, sir. That was very, very informative and good to see. I mean, I wasn't aware that you had a book out there, and I think that is something people can definitely, get insights from. So, could you
Sure.
tell us more about your book, though? A little more. Uh,
Yes. So, I mean, the book is titled The Financial Independence Marathon. It's available on Amazon and Flipkart, and essentially, it the motivation I got for writing the book was my interaction within my family members, relatives, friends, colleagues, and the general public, where I realized that there is still, like mm, in terms of awareness, like we are still not there, like you
right.
mentioned, right? A lot of people follow social media, they get influenced by opinions that we see there, or they read up on the internet,
Mm-hmm.
and it just leads to a lot of kind of confusion in people's mind, and either they are not able to act or react in the correct time frame, or they end up indulging in speculation, right?
Right.
And also I realized that many of the people in my network, they still don't follow the principle of asset allocation either. Like even in my family, for example, I know there are people who invest only in gold or only in real estate. They have not
Mm.
invested in equity. Like I am in the markets, but in my own family, people refuse to invest in equity. They only
Right.
keep their money in fixed deposits, right?
Mm.
So that's why I wanted to kind of put this across in a very simple manner, in terms of, one is the principle of asset allocation, how to think about it. Second is highlight five key principles of financial planning uh, uh, in a very simple way, and then how to keep your life simple by just investing in mutual funds, index funds, and ETFs, and so on. And if at all you want to invest in stocks, in crypto, and so on, then how to think about it and have it as a small allocation if you really want to do it on your own, right? And
Right.
there are of course a lot of books which talk about this, but the way I've tried to write my book is more in terms of a narrative format, in terms of there are characters, and there is uh, interaction between those characters
Right.
where they
Right.
discuss in terms of the life situation, and that's how I've tried to kind of bring this out. So you can
Mm.
check it out. Again, the title is The Financial Independence Marathon. It's available on Amazon and Flipkart.
Sounds super interesting. I think, yeah, great. I think more about as you talk about change in mindset is what is required within a lot of families who I think through
Right.
generations have invested in different asset classes. So I think it'll be a wonderful read. All right. So I think we have a bunch of questions, so I'll quickly jump to those.
Sure.
So someone asked that is it a good time to buy defense related stocks?
Yeah. So if you see, of course, like the if you see the biggest gainer from this conflict again will be the US, right? So given the geopolitical tensions now, NATO has been given a second life, right? And all the Eastern European countries again, they will want to feel safe. We have seen Germany has announced that they are increasing the defense budget. Other European countries are expected to follow, right?
Mhm.
So many of the defense companies, many of which are US based, they are expected to benefit. uh, in India, though, of course, we do have a defense budget, and in the recent budget that was announced, the finance minister said that they would increase the
Right.
allocation of the budget to private companies. They're going to spend more on R&D being done by
Mm.
private firms and so on. So, of course, there is more focus on the private defense companies, but there are only a few companies that you can invest in. That is the issue, right?
Mm.
And those are all well known. So it's not like you're going to find something that people don't know, right? So the
Right.
action is more on the international defense companies right now, and that's why we have seen that they are one of the beneficiaries of this crisis. In addition, of course, to the oil and gas and the metals companies.
Mhm. Got it. Okay, next question for you is amidst the uncertainty that is going on, should one invest in tech stocks that are heavily dependent on, say, the US and European markets?
Right. So, see, there are two things to consider here. So, one is, uh, like I mentioned, during periods of uncertainty, market valuations do get impacted.
Hmm.
The froth gets taken out from the markets. That is one of the developments that has happened. Second is, we are expecting interest rates to increase going forward, right? And that we have seen has already impacted the tech companies. Like, many of their tech companies are down 15-20%. Some of the unprofitable tech companies are down almost 50-60%, right?
Right.
So you can one way to think of it is like, sure, this correction is giving a good opportunity to invest, but there you need to make a differentiation between companies that have a good track record of earnings growth, that have proven earnings growth and a strong balance
Mhm.
sheet and proven management, and companies that are still, like, they are only just a story, right, where the earnings are not there or the cash flows are still back ended and so on, right? So in
Mhm.
the current environment, we are seeing that companies that have earnings and cash flow, they are still holding up quite well. I mean, they
Right.
have also seen a correction, but they're still holding up. Whereas companies which don't have earnings, which are still unprofitable, are really getting hammered. Like, they are down 60-70%, right? And
Mhm.
that can continue. So tech, of course, like I mentioned, it's like a decadal theme. We are very positive on the tech and digital space. It should be part of our portfolio. Uh, uh, Even in the fund of funds that I manage, we have a digital India fund which has these tech companies. So definitely you should have that as a part of your portfolio, but you need to be selective. It's not like last year where you can just invest in any tech company and it will keep rallying. So you have to be selective.
Understood. All right. So next question that's been bothering a lot of retail investors is should they stop their SIPs or not in these times? So should a retail investor stop their SIPs or not in this time of
Yeah.
uncertainty?
Right. So I'll tell you an anecdote. Like, in calendar 20, after the COVID pandemic happened, there was a big correction in equity markets. We were down almost 45%.
Right.
And the Nifty index fell from 12,500 to almost 7,500. Okay. So this is, I'm talking about in April 2020, March, April 2020. Right. And after that, the market started recovering and Nifty reached 9,000. And
Mm.
since from that day till today, I've had almost 250 such sessions with investors, with retail investors, high net worth individuals, with IFAs, with mutual fund distributors, and so on, right? And this question never goes away. Like, so, even when the Nifty had after its correction, it had rallied to 9,000. I was talking to a high net worth individual, and they said that market has already rallied. So should I'd prefer to wait on the sidelines rather than invest right now, right? And since then, we saw that the Nifty has doubled to almost 18,000, right? And then uh, the Nifty went to 10,000, 12,000, 14,000, 16,000, right? And this question or this point has always been there, where investors keep on saying that, should we stop our SIPs? Market has rallied or market is in a correction. Should we stop our SIPs and wait till we get more clarity and then come back in, right? So that doesn't work, right? So people
Mm.
are waiting since 9,000, Nifty 9,000 level, to come back in the market, right?
Wow.
And timing the market doesn't work. And I'm not talking of retail investors. I'm talking of high net worth individuals who have missed
Right.
out on the rally, right? So you
Hmm.
can't time markets. So that is point number one. And second, actually, as the market corrects, you should increase your allocation. Like I showed you, even from the market peaks that have happened, over a 10-year time frame, we can get a 11.5 to 12.5% CAGR return, right? And if there is
Hmm.
a market correction, then we can expect a higher return than that.
Correct.
Okay. So definitely don't stop your SIPs. Instead, whenever there is a, for example, 5% correction in markets, you should put in some lump sum amount, right?
Right.
So
Hmm.
given that we have seen a 10% correction in markets, the way to think about it is you should be ready with some cash to deploy,
Hmm.
right?
Hmm.
But always think in terms of your asset allocation. So, for example, if equity is already, let's say, 70%, 75% of your portfolio, then you can wait. If
Hmm.
equity is, let's say, 40, 45, 50% of your portfolio, then it's a time to start thinking of, adding to that exposure.
Adding to it.
That's why I
Right.
mentioned that have that asset allocation perspective in mind and have some cash ready. If there is
Hmm.
a correction, deploy some more and increase your equity exposure.
Hmm. Hmm. Awesome. So I think this is a part of the life cycle of an investor. So just, I know, just manage your asset well. Okay. So I think this is something you shed light on during your presentation. But if you could pinpoint on the sectors that are negatively as well as positively impacted by the whole ongoing situation with Russia, Ukraine, that would
Right.
be great because I think that is something the users want to know.
Yeah. So the way to think about it is, the rise in commodity prices is going to increase the cost for a lot of companies in different sectors, and that is
Hmm.
going to reduce their margins, right? And hence the earnings growth, right? So if you see the sectors where crude oil and its derivatives play an important role, so one is, for example, paints is an important sector, right? Cement, where coal also, say, both crude oil and coal prices impact that sector. Aviation is there. We have some of the FMCG companies which get impacted. We have some of the consumer durables companies which get impacted. So overall, if you see, it's mainly the discretionary, consumer discretionary type of sectors, right, which get impacted
Hmm.
by the rise in crude oil. Then another sector which gets impacted indirectly is the banking and financial services. So what happens is, as the crude oil prices rise, as inflation increases, it impacts the purchasing power of consumers, right? So we have to pay more for fuel and for transportation. So we end up kind of reducing our spending from some other pockets, right?
Right.
So consumer demand goes down, so that reduces growth in the economy, and hence
Hmm.
that impacts the banking and financial services sector. So in terms of sectors get impacted negatively, it's mainly, like I said, the consumer discretionary type of sectors and the banking and financial services sector. And the sectors that get benefited are the defensive sectors like IT, pharma, and healthcare, and so on. Because whenever there
Hmm.
is uncertainty, investors tend to go to these defensive sectors.
Got it. All right. Next question is, what are your views on the ongoing FIIs that are selling since the last few months? And how important is the role of FIIs and FPIs? How long will the outflow continue?
Right. So we are seeing a large outflow from FIIs since October.
Mm,
It started with the concerns on the US Fed raising interest rates, right? And now, of course, with the geopolitical tensions, it has increased, right? Uh, and like I said, in the short term, we can expect that outflow to continue. So the Fed is expected to start its first rate hike in March. So people are waiting for some clarity in terms of how many rate hikes will they guide us to, what will it, whether it be 25 basis points, 50 basis points, and so on, right? So that is one uncertainty which is there. And of course, how this Ukraine and Russia conflict pans out, that is there. So in the
mm,
short term, we can expect the FI outflow to continue, right? But if you think like a FII fund manager who's sitting in New York, London, Dubai, or Singapore, what they are also thinking about is, if I take a 3 to 5 year horizon, in which country do I get the best visibility to economic growth and earnings growth, right? So they
mm,
are comparing India with other countries, right? And they are trying
mhm.
to see where should I invest my money to get the best returns. And in that respect, India still comes out ahead. So if you see what is happening, other countries like US, European countries, other Asian countries, they were ahead of India in recovering from the COVID pandemic. So they have peaked out, and the economies are now kind of slowing down. Okay, whereas
Mm.
India is just coming out of the recovery of the pandemic. It's on the recovery path, and the next 3 years we are expected to be on the expansion zone. Okay,
Right.
so it gives India gives higher visibility to economic growth, and
Mm.
earnings growth also, like I said, is expected to be very strong, about 15% every year for the next 3 years.
Mm.
So with that regard, India still is a very attractive destination for FIIs, and hence after this short term uncertainty gets over, we expect FIIs to come back to India. Okay,
Mm.
that's one point. And second, of course, our domestic flows continue to be strong. Every month, like I said, mutual funds are getting 20,000 to 30,000 crores of inflows. Retail investors are also investing directly in the stock markets, and that is
Mm.
also supporting our markets, right? So, so there is short-term impact of the negative sentiment, but uh, even in the second half of this year, we should see FIIs coming back, and over the next years, we are quite positive on both FII and domestic flows supporting our markets.
Understood. All right. Next question is, what can be a good investment strategy to be followed by retail investors?
So always, start from the principle of asset allocation. I can't stress that enough. Just prepare a kind of a pie chart for yourself in terms of how much of your overall portfolio or net worth you have invested in domestic equity, international equity, fixed income, gold, and crypto, for example, if you have that, right?
Mm-hmm.
uh, that is the starting point. Unless you have that clear picture, you will always be confused and you will not be taking the right decisions, right?
Right.
And after that starting point, then you look at, okay, now given the current environment, given that there is a correction in equity markets which is going on, you can start thinking of increasing your equity allocation, right?
Mm-hmm.
uh, and that also depends, so for example, in our asset allocation fund today, we have about 40% equity allocation, but we have kept the cash ready to start increasing our equity exposure to almost 50, 55, 60%
Mm-hmm.
whenever we think the timing is right. So be ready with that. Have some allocation to gold. Like we have seen, for example, many investors thought that crypto was a hedge for inflation. It was a replacement for gold, but we have seen that
Mm-hmm.
that has not panned out actually, right? Crypto has actually, it's a high risk, high beta asset. It has been more correlated to the tech stocks, right? And it has fallen along the tech stocks, whereas gold has proven to be the hedge against inflation and the geopolitical crisis. So gold has rallied, right? Uh, so if you want to think of as if you want to have an hedge against inflation in your portfolio, you need to have gold. So have
Mm-hmm.
between 5 to 10% allocation, 5 to 15% allocation to gold. You need to have some allocation to fixed income because that provides stability to the portfolio, right?
Mm-hmm.
That's a way to think about it. And since I know that many of your investors are millennials who are invested or who want to invest in crypto, I just like to mention that, see, what we have understood from this current geopolitical crisis is that one, uh, crypto is not a hedge against inflation, and it's not negatively correlated with the other asset classes. It's actually very highly correlated with the tech stocks, right? But
Right.
where it has come out on a stronger footing is that it is seen as an asset which cannot be seized by the government. So what we are seeing is, the US government, European government have put sanctions on the Russian oligarchs, and they are seizing their assets, right?
Mm-hmm.
And many of these people are now moved to crypto so that that their assets can't be seized. Their crypto assets can't be seized, right? So that is the strong point of crypto. That's a way to think about it.
Fair enough. I think this is something you covered, and you also said a lot of people are waiting since the 9,000, range of Nifty. So, is it a good time for them to start lump sum investing? So, it is basically the question was, is it a good time to do lump sum investing right now? And you said that we could, put in some money right now and invest. But, is this the best time to do it?
Right. So, see, we have already seen a 10% correction in markets. There is still a lot of uncertainty given, what can happen in Ukraine, how the Fed will react, how high the commodity prices can go, and so on, right? So definitely, it's possible that we can see further correction, right? But we are not expecting a major correction from here. So given that view, if I had to invest some amount, some lump sum amount, I would not invest the full amount today, right?
Okay.
So, and the best example I can give you, instead of talking theoretically, is our asset allocation fund, where we invest in these four asset classes: domestic equity, international equity, fixed income, and gold, right?
Mm-hmm.
So as the markets had rallied, we had slowly reduced our equity allocation. It's about 40% now, but we are ready with cash to invest, right? And slowly we'll be increasing it to 45%, 50%, 55%, 60%, and so on. And that's the way you can also think about it. Like, have some cash ready to deploy, but don't invest all of it in one go, right? So every time there is a 5% correction in the market, invest a portion of the lump sum amount that you want to invest. Don't invest everything at one go. Nobody can predict, like, whether it's the end of the correction, or if it can markets can continue correcting going forward, right?
Mm.
So the best way is to act at regular intervals, and not put all your lump sum at one go. That's the best way to do it.
Got it. Okay, next question is, should we bet on the overall market and invest in index mutual funds rather than active funds?
Yeah. So again, so there, what we are seeing is, in the US and other developed markets are very efficient. So we have seen there's a big movement away from active funds to index funds and ETFs. But in India, we have seen that the markets are still not, very efficient. Like,
Mhm.
last year, for example, the large cap Nifty index gave a 25% return, whereas mid cap index and mid cap stocks gave more than 45% return, and the small cap indices and stocks gave more than 60% return. Some stocks gave 70, 80, 100% returns also, right? So, and especially given all the uncertainty in markets right now, we are in a what we call a bottom up stock picking environment. Okay. So at the actually the indices at the you may see more correction at the index level, and in some stocks which are not profitable, whereas other stocks which have a good track record of profitability and cash flows, it's possible that they will hold up, right?
Mm.
So we are really in an environment where we expect bottom up stock picking to work, and we expect that the active fund managers will be able to generate alpha. They'll be able to outperform the indices, right? So hence, our recommendation is that investors should continue to invest in active funds. Of course, a small allocation can be done to index funds. So, for example, instead of investing in a large cap fund, you can invest in an index fund or the Nifty ETF. But
Mhm.
then we recommend that you invest in a diversified fund should get larger weightage, like a flexi cap fund, large and mid cap fund, multi cap fund. They should constitute almost 35 to 40% of your portfolio. You should have some mid and small cap exposure also. Should have sectoral thematic exposure also, right? So on those accounts, it makes sense to have active funds also in your portfolio.
Got it. Okay, one last question. So you talked about having some allocation in gold. So someone asked, so what is the best product to buy gold?
So best way to do it is through the gold ETFs, right?
Mhm.
It's very liquid. You can buy and sell during market hours, right? You don't need to worry about holding physical gold and so on. So we recommend investing in the gold ETF, and if so, that needs, of course, that you have a demat account, which of course you will have with Groww and so on. So that's the easiest way to do it. Other alternatives, of course, there are the sovereign gold bonds and so on,
Mhm.
uh, but there you don't have that kind of liquidity. So it's best to invest in the gold ETF. Like, even in our asset allocation fund, we have invested in gold ETFs. We earlier we used to have almost 15% allocation to gold. As the prices have rallied, we have reduced it slowly to about 10%. So it gives you that flexibility. You can have between 5 to 15% allocation to gold in your portfolio, and investing it through these gold ETFs gives you that flexibility to, like, increase or decrease your allocation.
Fair enough. All right. So I hope everyone's questions are answered, and it was a great session. I think, honestly, at a personal level, also I learned so much, understood so much, because there's only so much you can get from internet and doing your own research. And I think a lot of people attending this are very busy folks, must be doing other things as well. So I think great insights. So thank you so much, sir. Anything you would like to say? Your parting words to say the audience until next
Yes.
time.
Yes, so to keep things, My advice to investors, based on my own experience, is keep things simple. Make your life as simple as possible. Easiest way to do it is to invest in mutual funds, index funds, and ETFs. If you want to invest in stocks, crypto, do it definitely. Everyone needs that excitement in their lives, but have it as a reasonable portion of your portfolio. That is point number one. Second, have a clear framework so that you can interpret whatever is happening in the world. Like I mentioned, in the short term, markets are driven by valuation. So there, the four parameters I talked about, earnings growth, liquidity, interest rates, and sentiment on end flows. These are the
Hmm.
four parameters to keep in mind, and try and interpret everything in terms of how it relates to these four metrics, because that will drive markets in the short term. But in the medium to long term, 3 to 5 years, markets are driven by earnings. So you need to have some understanding of expected earnings growth in the markets, right? So this is the framework to use to keep your life simple. And lastly, of course, I'll repeat, do check out my book, The Financial Independence Marathon, available on Amazon and Flipkart. I've explained many of these things there. Maybe it'll help you and your family, friends, and colleagues also.
All right. Thank you so much, sir. And I think everyone has said, they're thanking you. Maybe you can check out the session later
Sure.
in your own time. And I think there were great comments. People really enjoyed the session and learned so much. And thank you, everyone who attended this session. I know it's a Friday evening, and for you to take out time and attend this means a lot to us. So we will be back again next week with another cutting edge topic. Till then, all of you take care and bye bye and have a great weekend.
Thanks, Richard. Thank you, everybody. Take care.
Thank you so much.